All right, let's jump right into this explainer. If you've been glued to the tickers lately, you know exactly what I'm talking about. The vibe has totally shifted. We're navigating this wild, honestly kind of brutal intersection of sticky inflation, a massive tech reality check, and a huge rotation of capital. So my goal today, to cut right through all the noise and show you exactly what the data is screaming at us about this June 2026 economy.
I want you to think about this quote from Martin Bukardex. Hopes and dreams have taken markets this far. Reality will decide where they go next. It just hits the nail on the head, doesn't it? For the last couple of years, we've been surfing this massive wave of hopes and dreams, especially in the tech sector. But here's the thing. Hope is not a fundamental. Dreams don't pay for server farms. We're finally seeing that inevitable crash between those sky-high market promises and some very harsh, literal real-world constraints.
So to make sense of all this, here is our roadmap. We're looking at the macro market squeeze, AI's brutal reality check, the physical power bottlenecks, where the smart money is actually rotating, and finally, some impending market catalysts you absolutely need to watch.
Kicking things off with Section 1, the macro market squeeze, from geopolitics down to our pocketbooks.
Okay, look at this. We're seeing a pretty significant equities unwind across the board. The Dow, the S&P 500, the Nasdaq, they're all taking hits. But check out the extremes here. While industrials have taken a harsh dive, down 3.4%, consumer staples are actually up 1.7%. This isn't just some random market jitter. It tells us that capital is aggressively fleeing those crowded, high-flying momentum plays and running for safe havens. It's a classic textbook defensive posture.
And we can actually map out exactly why this defensive crouch is happening. It's a chain reaction. Step 1, geopolitical friction bottlenecking the Strait of Hormuz. That immediately triggers Step 2, an energy shock pushing Brent crude well over $90 a barrel. And you know expensive oil bleeds into literally everything, driving Step 3, sticky inflation, with headline CPI peaking at a really tough 4.2%. The grand finale? Step 4, the Fed is effectively frozen. The odds of a rate cut have basically evaporated to under 4%. They are locked into a prolonged hold, and the market is suddenly forced to digest that longer-term reality.
Which brings us to Section 2, AI's brutal reality check, the true cost of all this growth.
So, as the macro environment tightens up, the biggest growth engine we've had for the last few years is hitting its own internal wall. For the last 15 years, the tech bull run was heavily fueled by stock buybacks. Companies made a ton of cash, bought their own shares, prices went up. That was the old reality. But the new reality? It's a total 180. The Magnificent Seven and the broader AI ecosystem are facing serious capital exhaustion. Instead of buying back stock, they're flooding the market with massive equity offerings just to pay for the physical infrastructure AI needs. Look at Supermicrocomputer. They had to issue a $7 billion offering just to fulfill their AI orders, and their stock tanked 28% right after. Buybacks are out, and unprecedented share dilution is in.
To really wrap your head around the sheer, jaw-dropping scale of this capital drain, just look at this number, $70 billion. That is Oracle's projected capital expenditure for fiscal year 2027 alone. $70 billion needed just to feed its AI infrastructure, which is forcing them to plan a $40 billion capital raise. When investors look at numbers like that, they're starting to realize something scary. Yes, the cloud is growing exponentially, but the massive mountain of debt required to keep it growing might actually outpace the returns.
So the million-dollar question is, are these projected returns even mathematically realistic? Well, if we look at historical base rates applied to this AI boom, it's wild. Out of 19,000 large companies throughout history, practically none of them match the expectations we're seeing today. Take OpenAI. They need a 108% compound annual growth rate for 5 straight years just to hit their current valuation targets. Sustained exponential growth at that kind of scale, it sits entirely outside the bounds of historical reality. I mean, it has virtually never happened.
Moving right along to Section 3, the physical power bottleneck, or as I like to call it, grounding the cloud. Here's the thing about AI. It's not just about digital code and silicon chips. We are colliding with the actual laws of physics. The abstract cloud is crashing into a very real-world limit, electricity. AI demands an absolute massive amount of power, and our traditional grids just cannot keep up. In places like Texas and Pennsylvania, if you want a grid connection, you're waiting years, literally years. So to get around this massive roadblock, hyperscalers like Meta and Microsoft are going straight to companies like eRock. They supply these gigantic, Lego-like on-site natural gas generators to just bypass the traditional grid altogether.
And how is the market reacting to this power bottleneck? It's fascinating. eRock recently went public with a $5.9 billion valuation. Now get this,
Despite currently running at a net loss, EROC trades at a staggering 32 times its projected 2025 sales. To put that into perspective, the absolute gold standard in heavy machinery, Caterpillar, trades at just 6 times sales. Investors are so incredibly desperate to unblock this AI power gridlock that they are willing to pay an historic, extreme premium for anyone providing the literal, physical juice to make it run.
Which leads us perfectly into Section 4, the smart money rotation. Where is the capital actually moving right now?
Well, out in the real economy, we are seeing an undeniable pivot toward value and what I like to call the nostalgia premium. Consumers are feeling the squeeze big time. I mean, with median rent in NYC breaking $3,600, you literally have young professionals moving into convent-style boarding houses just to make ends meet. Meanwhile, brands that offer comfort and true value are absolutely surging. Cracker Barrel shares shot up 35%. People are flocking to familiar, value-driven nostalgia, and even in entertainment, the old bloated models are breaking down. Gen Z YouTube creators are dominating the summer box office with viral hits made on a fraction of the budget of traditional studio sequels. Across the board, value and efficiency are winning the day.
So how does this translate for the big institutional players? Where's the smart money going? It is aggressively fleeing the overcrowded software spaces, those hyperscalers getting crushed by capital expenses. Instead, they're moving down into undiscovered value. They're buying up the physical AI supply chain, things like memory chips. They're buying physical infrastructure, like power generation utilities. And they're hedging with small caps and gold miners. The trade has officially flipped. We aren't buying the promise of AI anymore, we're buying the picks, the shovels, and the power lines needed to actually build the thing.
Finally, Section 5, impending market catalysts. We know the reality, but what happens next?
Over the next few days, we are facing an absolute gauntlet of economic and social catalysts. Just look at this timeline. Thursday morning, we get wholesale inflation data and the European Central Bank's rate decision. Then Thursday afternoon, Adobe reports earnings, a huge health check for the viability of AI software. By the weekend, the 2026 FIFA World Cup kicks off across North America, which is going to unleash a massive wave of localized consumer spending. But sandwiched right in the middle of all of this, on Friday, is the main event.
Friday brings the ultimate near-term litmus test for market sentiment, the $1.8 trillion SpaceX mega IPO. This is it. This is where hopes and dreams literally meet cold, hard, open market reality. Now, the bulls will tell you that $1.8 trillion is totally justified because of Starlink and AI integration. But the bears, they point out that it's trading at 92 times sales, generated zero profit last year, and is built almost entirely on promises. When this behemoth starts trading, it's going to tell us exactly, and I mean exactly, how much appetite investors still have for these high-capital, sky-high mega valuations.
Which brings us to our final thought. Tightening economies and bear markets, they always inevitably force a discount on reality. The era of free money funding endless promises, that's pausing. It's stepping aside for the physical realities of infrastructure, power grids, and just basic, bottom-line consumer value. So as you look at your own strategy moving through this June 2026 market, you really have to ask yourself one question. Moving forward, are you positioned for the hype or are you positioned for the hardware? Thanks so much for hanging out with me for this explainer, and I'll catch you in the next one.